Ratings agencies have had such bad press since the financial crisis of 2008. Is it justified? I don't know. Let's delve into it a little bit more deeply now, because as the role of credit rating agencies has expanded, the scope of the criticism of the industry has followed suit. A number of concerns have been voiced as to the extent to which they can have a serious impact on financial stability. But who are they and why are they so powerful? CNBC's Africa's Nastasia Arantxa reports on this matter. Here it is.
Downgrades, AAA, investment grade, junk. The jargon of the credit rating agencies. For decades, it was never heard outside the financial markets. But now, barely a week goes by without an appearance in the news headlines. Credit rating agencies were created during the start of the railroad construction era. Railway companies needed loans to pay employees, buy material, and investors saw an opportunity to invest their money profitably but did not know which entrepreneur would be able to repay their loan with interest.
The purpose of ratings agents is so that companies can access public capital markets to raise debt.
Rating agencies provided valuations looking at the creditworthiness of these companies, the result of which was sold to investors in the form of credit ratings. The ratings reflect the probability of whether borrowers would be able to repay their debt. AAA is the highest rating. The higher the rating, the less risky a borrower is perceived to be, so the lower the rate of interest which has to be paid. D is the lowest rating, and that means that payment default has already occurred. The ratings determine how much interest has to be paid.
When you look at a bond or a debt instrument specifically, we have to take into account the underlying obligor or the issuer of that specific instrument. And then we take into account, over and above that, the specific nature of the debt instrument. What are the characteristics of that specific instrument? And we then assign a rating to a specific bond or commercial paper note or structured finance obligation.
It's in environments like this that the creditworthiness of nations and companies are made. Groups of analysts will convene by either teleconference or by video conference to deliberate the arguments, and these meetings can be extensive.
We would have our internal credit committee. It's not just one person then that would decide on what the rating is. There would be a primary analyst who does the work and presents in committee, and the committee makes the decision. So it's a fairly structured process, which also makes sure that vested interest or a particular interest cannot sort of impact on the rating decision, because the decision ultimately is done by a credit committee. And that's quite a wide, diverse group of people. And once the committee has made its decision, we communicate that back to the issuer, back to the company, back to the client. And the client then can decide, okay, I want to go public with this rating or I want to keep it confidential.
In the US, criticism has been leveled at the agency's ratings of Enron before it crashed in late 2000. The Securities and Exchange Commission was given powers to oversee the agencies, which had to register with the financial watchdog. What was becoming clear was that there was scope for serious conflicts of interest, because by the late 20th century, the business model had changed. It was the bond issuers who paid for the ratings. And that became acutely clear after a much bigger financial crisis developed.
So post-2008, ratings agents are really on the outs, both with regulators and with investors. Investors feel they've been misled, and in fact they were. The regulators have lost faith in the ability of ratings agents to maintain independence and objectivity and run due process. And as a consequence, they've been written out of legislation.
Sometimes you get it wrong. Now, your criteria should be so robust and your analysis should be so robust that these incidents where you get it wrong are very rare. And they certainly have been very rare until 2007, when we had the subprime crisis. I mean, we had some high-profile incidents, accidents if you like, in around 2002, 2003, when the ratings for WorldCom and Enron proved to be wrong. Which led to a lot of soul searching in the company to find out what had gone wrong. And we looked at our criteria, we revised criteria, and we thought we had learned a lot out of those two incidents.
We were not very happy with the performance of our specifically US mortgage-backed security ratings. They haven't performed the way we wanted them to perform. However, if you look at many of our other ratings, they performed incredibly well. If you look at corporate ratings, for example, the 5-year cumulative default rate on corporates for corporates that have an investment grade rating is 1.13% since 1983 up to 2012. So our ratings, I think, have a very strong performance. But like I said, there have been instances where we haven't been fully satisfied with the performance of some of those ratings.
But the agency's power does not always cause mass market upheaval. Most recent downgrades have not prompted swings in investor behavior. After the US received its downgrade in 2011, rather than its cost of borrowing going up, it actually went down, as lenders decided that the US government was still one of the safest bets in the world.
In the U.S., of course, there were allegations after, I think it was Standard & Poor's downgraded the U.S. from its AAA rating, that suddenly the U.S. Congress got very aggressive with the ratings agents about legislative issues. It was very ham-handed, if you will, saying to link the two together when ratings are supposed to be objective, but the politicians didn't like the answer, so they actually came at them with a club. So that's kind of the worst kind of behavior that you'd expect from an issuer.
Governments have to contend with the reality that rating agencies are still embedded in the financial markets. And it's clear that these agencies are accountable both to investors and other users of their ratings.
The rating agencies in the US got regulated by the SEC. I think that kicked in about 2008, 2009. In Europe, subsequently, a European-wide regulator was put in place, ESMA. And ESMA started regulating the rating agencies in about 2011, if I'm not mistaken. And here in South Africa now, a credit rating services bill has been approved by Parliament, signed by the President, and was promulgated actually in January this year, which means that in the coming month, we as rating agencies, we will also be regulated in South Africa, and the South African regulation is very much drawn up along the lines of the European regulation, which is, I guess, at this point in time, the best practice in terms of how credit rating agencies are being regulated.
South Africa's credit rating was downgraded last year on the back of a slowing economy and a restless labour market. How much change is needed to prevent further downgrade is anyone's guess. But pricing out rating agencies will not be easily achieved.